Dividend investing is awesome, but it isn't for everyone. There are some things you should know before you jump right into it, and I want to arm you with as much knowledge as possible. I've seen some people get really dialed in and absolutely kill it, and others have fizzled out completely because it wasn't what they were expecting. In this video, we're going to answer the question of your motivation for considering this approach to wealth building. Right now, dividend investing is receiving a ton of attention. Google Trends shows interest in it to be extremely high right now, and at one point, it hit the highest level of interest that they measure. Obviously, the appeal of income completely disconnected from our hourly labor is a powerful one. It's so attractive, this thought of being able to live off of dividends and not touch our capital, that it's tempting to raid our bank account of every cent, buy some high dividend paying stocks, and do the countdown to financial independence. But before you do that, let's dive into this a little bit more to figure it out. First up is that I don't think dividends should be the deciding factor of whether we invest in a company or a fund. Dividend investing has ups and downs like any other form of investing. Since 1930, dividends have accounted for 40% of the stock market returns, and that goes up to 54% when you focus on the 1940s, 70s, and 1980s when inflation was high. The downside to this is that when inflation is high, you often get higher interest rates from savings accounts and CDs. If you can get 3.5% or 4% in interest in a savings account, it makes the 2 or 3% dividend yield of a stock seem kind of boring. We want to make sure that we are investing in companies that will appreciate in value long term. Inflation will rise and fall, as will interest rates. If we're investing in good companies paying solid dividends over decades, we'll be okay. If you're looking for a quick jolt of cash from a dividend portfolio in a market downturn, this may lead to some disappointment. At the same time, when stocks are down but you're still getting a dividend, it can help offset some of the market declines. So I mentioned earlier about being conscious of our motivation and how we intend to invest. Is our motivation to be financially independent prior to 59 and a half? If so, it might make sense to dividend invest, but then we have to examine the how. We can pull money from a Roth IRA tax-free at 59 and a half, but not before without penalty. This means we wouldn't be able to access our dividends inside a Roth IRA. So for a Roth IRA, it makes sense to go for the highest overall returns that we can, regardless of dividends. The same age of 59 and a half applies for a 401k. A 401k usually has limited funds that we can invest in with taxes and fees for early withdrawal, and again, like a Roth IRA, we cannot access those dividends. So if we're interested in some kind of income before 59 and a half, these retirement accounts aren't the vehicle through which we should invest in dividend paying stocks if our goal is to have access to those dividends before retirement. Now, if you intend to dividend invest in your different retirement plans, just keep in mind that we want to prioritize overall returns. This leaves us with an after-tax brokerage account. So the first question is, are you able and willing to contribute money to a brokerage account outside of any retirement accounts over a long period of time? If so, let's keep going. Third is that dividend investing is not necessarily a set it and forget it approach to investing. There are funds out there that are dividend growth oriented that can be put on autopilot with reinvestment. But if you're thinking individual stock, this is going to take work to research and build a portfolio to get started. You'll want to explore all the dividend kings and dividend aristocrats out there as a starting point, but that's a fairly large list of stocks. If you're really busy, just don't have the energy or care or the time to devote to it, you may want to just consider buying an index ETF or mutual fund and moving on with your life. You're going to be buying the market when you do this, and although it won't be generating much income for you, you'll be able to capture any gains that the market may have experienced. VOO and VTI come to mind, and they both pay dividends between 1.5% and 2%. Vanguard also recently came out with a new ETF called HTLB. It stands for Hit the Like button and is also available in Admiral shares as a mutual fund. The returns are unbelievable. Next is that we must be willing to put on our analytical hat and research these different securities and the companies that they represent. When it comes to profits, all companies have a few options. They can repurchase shares, they can take the money they've made and reinvest it back into the business, or they can issue a dividend to their shareholders. The board of directors determine whether to pay a dividend, and if so, whether to pay it quarterly, which is the most common, or annually. There are some funds out there that even pay a dividend monthly. They can pay it in the form of cash, and many companies offer their shareholders a direct reinvestment plan, which is called a DRIP, where they take the dividend and reinvest it right back into the stock on your behalf. This is helpful because it eliminates transaction costs, and sometimes you can get a discount. We want to think big picture here. If a company takes $1 and turns it into 80 cents, that's not necessarily an effective use of cash flow. I would rather they pay me a dividend so that I, as the shareholder, can try to do something with the cash. But if they they take that $1 and turn it into $1.20, I love that because we'll see greater cash flow out of that company. Their stock will likely rise, and as a result, we the shareholders will enjoy greater capital appreciation. If that's the case, I don't want the dividend. If I need or want the money, I can just sell the share and lock in those gains, especially if there's been a significant amount of capital appreciation. We must also be able to see the bigger picture with our overall investment strategy. The nature of dividend investing is that there's this carrot dangling out in front of us that's really attractive, and that is the temptation to hunt down the one with the highest yield. This is called the dividend yield trap. What many new dividend investors miss is that a dividend yield is expressed as a percentage of the price of a security. The higher their percentage goes up, the greater the chance that the security is dropping in value, and thus the payout is a greater percentage. So a 9% dividend looks really attractive. However, if we look at the company and see that the stock price is currently $50 a share and they're paying out a $4.50 dividend, we probably want to look at their history. If a year ago they were trading at $100 a share and paying that exact same $4.50 dividend, it was a yield of 4.5%. This may be a great company, and buying a great company at a discount is awesome, but you don't know that until you do your homework, and if all you're doing is chasing dividends for the highest yield, you're likely going to get burned. High dividends can sometimes hurt a company that may need the cash, and a higher percentage yield can be indicative of a drop in price or trouble with the company. We can look at earnings to figure out a payout ratio, but I'll cover that in a separate video. We must always pay attention to total returns, which is capital appreciation plus dividends. Let me put it another way. Let's say we have stock A and stock B. We pay the exact same $100 a share for each of them. While stock A pays a 4% dividend, stock B only pays a 1.5% dividend. The initial temptation for many new dividend investors is to jump on that 4%. And that may not be a bad decision in the long run, but we have to dig deeper. Company A may be stalling out on their growth, and as a result, their stock may only be growing at 1% a year. They may decide to continue to grow their dividend by 5% a year. After 5 years, we have an overall growth of about $131. We own 1.25 shares, and we were paid $25 in cash in the form of a dividend. Company B's valuation is growing more aggressively at a rate of about 5% a year. Their dividend growth rate, for the sake of an apples to apples comparison, is the exact same 5% increase annually as it was for Company A. At that same 5-year period, the investment grew to $131. We own fewer shares of just over 1 share still, and we were only paid about $9 in dividends. But if we were to sell off, the capital appreciation of Company B stock would give us an overall higher return, and we would have made more money. It's just something to keep in mind when it comes to dividend investing. Alright, next is we must be patient. Saving money takes time, and compound interest takes time. If it was easy to build wealth, everyone would be doing it. If you're contributing to your Roth IRA, your 401k, and dealing with other financial obligations, you may not always be able to throw large chunks of money into your brokerage account. If getting $5,000 a month in dividend payments is appealing to you, but your time horizon is 3 to 5 years and you're starting from scratch, I hope you have a massive income. Dividend investing is usually through large established companies. These companies don't tend to explode. Their growth is usually over time, plodding along and steadily adding value. If you want to get rich quick, I think you'll be disappointed. Dividend investing is like most things in life. It starts out slow and builds momentum from there. Build your knowledge, increase your savings muscle, and get into the habit of saving and investing. Over time, with focus and persistence, you will get there. If you like this video, check out some of my other investing videos. Thanks, and I'll see you next time.